Hi, this is Mike Zahora, and welcome to Basic Business. Today we're talking to Rob Stone. Hello, everyone. Welcome to TPNN, the Profile Netcasting Network, broadcasting from the Profile in beautiful downtown Vancouver. Brought to you by Mr. Taxes. Visit them at mrtaxes.ca. Tell us a little bit about yourself, your Mr. Taxes.
Well, our company is Mr. Taxes, so it's mrtaxes.ca, mrtaxes.ca, or mister taxes.ca. Phone number is simple, 604 Mr. Taxes. We've been doing income tax and accounting since 1983. We have a couple locations around the Lower Mainland here, so we're predominantly in Vancouver, but we do income tax returns for clients across Canada right now.
Okay. And, we're looking at it from a business perspective. Let's say I just started a new business. What would you say are the top 2 or 3 things that I need to know from a tax perspective?
Well, number one is, are you going to incorporate or not incorporate? That's the questions we get a lot from new business owners. They'll have an idea, or they'll have a skill or a trade, and they want to go it on their own. And they're wondering, should I incorporate or should I be a sole proprietor? So that's the first consideration. And one of the questions we ask the client is there liability as far as personal or property liability? So for example, if you're a tradesperson and you're working on a house and you drop your hammer through somebody's windshield and it hits their baby, are you going to be sued, or is your company going to be sued? So there are some things you can do if you just want to be a proprietor to protect yourself with regards to liability, and that's insurance.
Okay.
The second main consideration is, of course, tax. Now, we tell people that if there's no risk with regards to liability, there's usually about $180,000 to $200,000 threshold where once your income reaches that level, for tax saving purposes, you should look at incorporating.
So after the 180 to 200,000 mark, you should
definitely incorporate to save on tax.
Okay. But before then, if there's no liability issues, it's not a big deal.
There's not a big deal, and you have to look as well, is a potential to earn more than that. So if there's a high potential, everybody wants to make $1 million.
Yeah.
But if you know you're only going to be making $60,000 to $80,000 and that's all you want to earn, there's not really any point in incorporating. Somebody who's in retirement now, a retired teacher doing consulting on the side, they don't want to make $1 million. They're collecting their pension. If they do make too much, their tax is going to go through the roof.
Okay.
So there's other considerations, but the 2 main ones are liability and tax savings.
Okay. And what about with regards to taxes? And did you have a separate account for your taxes, or do you keep everything in one business account? What's your recommendation for that?
Well, let's look at a proprietorship, because the majority of people that are going into business are going to start a proprietorship.
Okay.
I say maybe a 20-80 rule. 80% will be a proprietorship. So if you do have a proprietorship, you can keep one bank account. A lot of people have the notion that they need a separate bank account for their payroll, a separate bank account for their HST, a separate bank account for their tax, and then a separate bank account for their personal, and a separate bank account for their savings. Bank accounts incur fees.
Okay.
You can have one bank account. The way to solve that problem is to have a proper bookkeeping system. And with regards to accounting, there's 3 basic components of accounting. There's tax, there's payroll, and there's bookkeeping. So
Okay.
Bookkeeping is a main component. And the number 1 rule in bookkeeping is save receipts for everything. Doesn't matter if you buy a pack of bubble gum, a new car, a new sound system for your studio, new computer. It's easier to take the receipts out that you don't need at the end of the year than it is to run around and try and find the receipts that you forgot to pick up at the store when you made the purchase. So if you have all your receipts, it's very simple. You can find a bookkeeper for very reasonable rates. It's something we do as well. Bookkeeping software is very cheap now. The information age has made it very accessible to the average person to buy bookkeeping software for under $200. So it's very easy to do yourself.
Okay. And so you're just saying I know this might sound cliche, but sort of having like a shoebox full of receipts kind of thing, and just drop it off to you at the end of the year, and you guys do that? Or is it recommended that somebody goes through them and sort of categorizes them first?
It's a great question. We have a simple filing system, and all it really does is take the Giphy codes from the tax return. And Giphy codes are different than GL accounts. And now I'm talking a foreign language probably.
Yeah,
but,
exactly. I'm like,
but
what?
Giphy codes are generally indexed financial information, and they have line numbers for every expense account.
Okay.
On a tax return. And all we've done is created a simple sheet of labels that you put on file folders, and then during the year you file your receipts into the proper file folders. That cuts our work down 50%. So we can cut your bill in half.
Okay.
And if your information or your receipts do come in a shoebox, most times we can sort that out within an hour or two. We try and keep the bill down, and we'll educate the client so that next year they can help keep their own bill down. They can start spending more time and earning income.
Okay. So it'll be a shoebox with dividers then.
Pretty much. It's the lowest common denominator. And a lot of guys in the trades, we do a lot of trades, tax returns for people working in the trades. They don't own computers. They don't know how to use one. They don't want to use one. It's actually less expensive for them to hand us the shoebox at the end of the year.
Okay.
You know, rather than buy a computer and learn bookkeeping and pull their hair out trying to do that.
Gotcha.
You know,
Is there bookkeeping software for people who do want to get into that end that you would recommend?
There is. There's two main ones. There's Simply Accounting and QuickBooks.
Okay.
And it depends on how educated you are in bookkeeping.
What if you've got no education
No
whatsoever?
education whatsoever. Stick with Simply Accounting.
Okay. So that's the best way to go. What else would you recommend for people who have their own business or starting to make some money now? Would you recommend them to, put money into like an RSP or some sort of a savings account to help them out in the future?
We're talking more about financial planning now,
Okay.
and ironically, we do have our financial planning licenses, Mr. Taxes, but a lot of people in the trades end up spending the HST money that they collect. So if they sell $1,000 worth of services to a client, they collect $50 in HST. At the end of the year, those $50 adds up. A lot of times that money's spent at the end of the year. So when we do the HST return for clients, which is a GST return now after April 1st, our clients don't have the money to remit to Canada Revenue. So what we suggest is they open a tax-free savings account, and all the money that they collect for GST now or payroll withholding taxes, they put into that tax-free savings account. Now, you can have up to $5,000 per year over the last 5 years, and last year was $5,500. So most people that have filed a tax return have $25,500 in eligible room inside their tax-free savings account. So you can put that money in there during the year. It grows tax-free, earning interest for you, not for Canada Revenue. And at the end of the year, you take out just as much as you need to pay your HST return.
And you've made some money.
And you've made some money tax-free as well. And the difference, you transfer over to your RSP, giving you additional tax savings.
Oh, that's awesome. Okay. Thanks for coming on the show, Rob. And thanks for watching.